in business. Singapore's second largest lender, OCBC, reported a record full-year profit for 2022, driven by strong growth in net interest income and lower allowances. Net profit jumped 34% on year in the fourth quarter to $975 million, missing Bloomberg estimates. Group net profit for the full year rose 18% to $4.3 billion, also missing estimates. A surge in lending income drove profit higher, but were partly offset by a drop in fee income. Net interest income grew 60% on year in Q4 to nearly $2 billion. Lower wealth management fees posed a drag on the bank's non-interest income. Net interest margin, a key gauge of profitability, increased 79 basis points to 2.31% in Q4 from a year ago. For the full year, group net interest margin rose to 1.91%. Shareholders can look forward to a bumper dividend. OCBC has proposed a final dividend of 40 Singapore cents per share. That's 43% higher from 2021. This brings its total dividend for the year to 68 cents per share, up 28% from the previous year. For more, Roland Lim spoke to OCBC Group CEO Helen Wong on the bank's growth prospects.
I think our key markets, as you mentioned, that would be Singapore, Malaysia, Greater China, Indonesia. I think these economies is going to outperform the global average. Of course, there is still headwinds regarding inflation, but Asia is relatively doing better as well compared to, we think that potentially there is a more recession risk in the US and in Europe. But the judgment is still, even if there is recession, could be quite short-lived. So hopefully Asia will still do better and will be able to tame inflation better as well.
China has reopened. Is that likely to cushion the blow for Asia? Or will it be gradual, or will it be a steep increase?
China's reopening, I think it does cushion the blow. It's not just for Asia. I think it does help the West as well because it's such a major economy. So we see that this is coming a bit earlier than people expected, which is good. So and this is just the first quarter of the year. So we hope that China's reopening indeed, in particular, will help Asia. And I think towards the end of last year, some of the forecasts for economic growth for Asia was actually down from the third quarter. But with China reopening, I think we have now more renewed confidence in how things may unfold in the rest of the year.
We have the US Fed possibly bringing interest rates up to 5% this year or more. This is an environment we haven't seen in a very long time.
Indeed.
How is that looking for your business? I mean, are we likely to see a tamping down of inflationary pressures?
I think a very good point which we are watching regarding interest rate movements, we're watching very closely. And I think we share the view of the market that potentially there can be another 2, and some people would say 3 increase in the Fed funds rate. That would continue to have a pressure on the economic activities, right? I think the whole reason about increasing interest rate is to tame inflation. And as you increase interest rate, then it will impact borrowing rates. So hopefully to dampen the consumption and also dampens in some other investment in order to tame inflation. So that is indeed happening. But I think in Asia, the central banks of different economies, they react differently, of course, judging on their own economic situation as well. It looks more like that the interest rate cycle may move to the end. I mean, this whole round of interest rate rising. I think as Asia probably step out from COVID better from last year to this year. So we think that interest rate impact is going to gradually subside. And for example, we don't actually necessarily look at lending. We also look at how our investors is behaving. So with the interest rate cycle coming more close to the end, investment sentiment investments has also started recovering. So in a way, as we have a very balanced franchise, so if your loan book is a bit more muted, you can expect, because of the performance of the equity and bond markets, that your wealth sector of things could perform much better. And then on your fee income, on the wealth fee income, and also because China reopening, so that could be help on the supply chain, on trade, and on the money flow. So your other fees will be increasing as well.
Okay. Now, unlike your rivals DBS or UOB, wealth management and insurance makes up more than 50% of your non-interest income business. Is that good or bad this fiscal year?
I think they would, the insurance and the wealth income this year should come back better than last year, based on what I just said, right? Interest rate cycle moving towards the end, renewed confidence in the economies, renewed business increased flows across Asia. So we do see that the insurance and the wealth income can potentially come better this year, but hopefully alongside the transaction banking fees as well. And with more confidence in the consumption market, if inflation is tame, then potentially spending can come back too.
So you're confident about customer investment activity, that the bank is able to attract new net money inflows into your wealth management franchise, for example?
Yeah, even last year when the investment sentiment is quite muted, we still have net new money coming in last year. So we're quite happy with that. It is the strategy to bring the cross-border wealth flow, right? As we said, this is one of our strategic pillars, is to capture the increase in wealth in Asia, which we have been managed to do. So based on what we have already received last year, we will see continuous net new money coming. And I think AUM, if the markets recover, there's also more money to use as well. I think last year we see some customers parking into higher paying deposits because of the lack of opportunities in the equity and the bond markets. I think this year some of that interest is beginning to come back. So I'm quite positive about our wealth and insurance and other fee performance.